What's up, everybody? Michael Silva here. Investors are preparing for a stock market surprise. That's what we're going to talk about in today's stock market brief. If you're new here, welcome to the channel. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated. Housekeeping really quick. Sorry I haven't had a video these last couple of days. I've been dealing with COVID. I'm already completely out of breath, just the start of this so far. So I'm going to do my best here to get through this. First and foremost, like we said, investors are preparing for a stock market surprise and how you can kind of prepare yourself for this market surprise too as well. First and foremost, the market completely ripped today to start the week. And we know that coming into this week, we have some important stuff coming out, right? Everyone's eyes are on inflation data, which is tomorrow, an hour before the market opens. And then we have right after that, the next big one is going to be the Fed conference as well as the interest rate decision. Now, as far as the consensus goes for inflation, we're looking at about 7.3 for the inflation rate year over year and 6.1 for the core inflation rate year over year. You know, there's a lot of deterring factors. People, is it going to come in hotter than expected? Is it going to come in under than expected? Look, I'll just tell you how the market's preparing for it right now and then kind of give you some nowcast numbers. If we look at the nowcast, I think this is the Cleveland Fed. We have November for CPI coming in at 7.49 and 6.26 for the core CPI, which would be above what this current consensus is. You can see 7.3 is consensus, where the Cleveland Fed is slightly higher. So yeah, can we get a 7.5? I think that's possible. And if it comes in hotter than expected, how's the market going to respond to that? Well, if it comes in hotter than expected, the market participants might see that as the Fed is going to continue to keep rates high, and they're going to keep raising rates and holding them at these high levels until inflation is obviously one. Just like the Fed said, in the prior meeting, just they're going to keep at it. If we take a look at the Fed Watch tool, there's a 75% probability that we are going to be getting a 50 basis point rate hike, which would take us to levels that we haven't seen since 2007, which is right before that recession. Clearly, we have a lot more debt in the system. Now, this is all on the back of we are still in a quantitative tightening cycle. And, you can see here, this red line is the S&P 500 and the blue line, that is the Fed balance sheet. And you can see they really go hand in hand. You can see the S&P 500 goes up, the balance sheet goes up. And then as soon as really we started tapering right here and started tapering talk, you can see that reducing the liquidity in the system, it added into massive illiquid swings back and forth inside of the S&P 500. We also have massively inverted yield curves. Still, the 10 and 2 is at minus 78 basis points and minus 77 basis points for the 10-year and 3-month. If you take a look at the 10-year yield as it stands right now, we are in a period of contraction right now, and we have the PMO starting to curl itself over. So, it's anybody's guess, but in the next 2 days, I would imagine we could see probably a pretty strong move, whether that's to the upside or downside right now in the 10-year yield. So as it stands right now, could be just a period of consolidation before we see a higher hit higher, which could be very bad for growth stocks. If you take a look at like the 10-year, 2-year curve where we've been in history compared to, where we are now, we haven't been here since the 80s. Okay. And you can see that every time we get these yield curve inversions, these gray shaded areas are recessions. So, we had an inversion, we had a recession, we had an inversion, we had a recession, we had an inversion, we had a recession, inversion, recession, recession, and we still haven't got that yet. So coming into 2023, chances are, we will be seeing more recessionary things start to take place. Now, why are we talking about that the investors are preparing for a stock market surprise? Well, the stock market was up today, right? We saw pretty green across the board of all the 11 sectors. The Dow was up 500 points. The heat map was bright green, other than Tesla, which was down a massive 6.27%. And this is all on the back of a VIX that was up, just over 2 points. So what does this mean? Well, this is potentially here just increased hedging taking place. And you can see that because if you're buying puts, increase hedging, it's pushing the VIX up higher, which brings, by the way, this calculation, if we're right at around 25, it correlates to around a 1.5% move on a daily basis in the S&P 500. And we've been seeing 2 sigma moves. So highly likely that come into tomorrow, we're pricing in around a 1.5 to 3% move, which we've seen these 3% moves on those CPI days. Okay, but when you take a look at skew is also up, and VVIX, right? Volatility was up too as well. We have NASDAQ vol that closed above 30 again, which is incredibly high there. And this is crash territory when you have volatility such as NASDAQ up in the 30s like this, and then you have Russell volatility also closing in the high 20s. You closed at, where did we close at today? 28.88. All right, so if we continue on and we start to look at what is the market actually pricing in going into tomorrow, first and foremost, let's look at the weekly expected move. And today we had a decent start to the week, right? It was just a little bit of a squeeze day. We closed at the high. Well, we're looking at about 40.50 for the upside for the upper weekly expected move, which brings us right to around the upper trend line again, right? A potential back test of this falling wedge, rising wedge, and then also the 200-day moving average. So it can bring us right all in confluence with this area of resistance. And then to the downside, we're looking at around just below 38.50. Now, tomorrow, just take a look here. This is just tomorrow's expected move. Tomorrow's expected move, it's these, you can just screenshot it. I'll bring it into the 15-minute time frame here momentarily, but 40.84 to the upside, 389.6 for the downside. Now, if we take a look at the 15-minute time frame, what you'll see here is price really just hasn't gone anywhere for, since the 10th of the prior month. We've just been trading sideways, and we've been seeing some rips to the upside, followed by, it getting faded. Then these last few trading days, which I haven't been active, prices really hasn't gone anywhere up until just the closing hour or so of today, where we had a little bit of a squeeze. This gray box up here, this is the expected move for tomorrow. That is a huge expected move. So the market is pricing in a lot more volatility, as you can clearly see. We can come above the weekly expected move come tomorrow. And by the way, very frequently, because the report's coming out right before the market opens, we might hit one of these edges out of the gate come tomorrow morning where we start the trading session. So if it comes in hotter than expected, we may come hit the lower 390 level. If it comes in under, the market responds great to it, it might come up all the way up here. Now, the thing is this, how do you prepare yourself for this type of risk? Well, it's event risk, and it's very binary. And if you do not want to participate in this, the way to reduce volatility in your portfolio is by lowering out your positions, right? Reducing your positions and your exposure to the overall markets. There's other various, advanced option strategies you can do, and I'm not going to get too much into that now, but what I've done personally is I've reduced my exposure greatly into the market because I want to be able to react and read what takes place after the report comes. I don't care about catching a move here early in the morning or here early in the morning. I want to see how the market's going to respond and digest the information in order to better manage risk, right? You got to understand the market is all about protecting your overall capital. And if you're going to, take a wild binary shot, make sure you're really focusing on the amount that you're willing to lose, because you can, if it goes against you, you might as well just tap out of the position. And if you put too much in, we all know that can be a bad thing. So yes, we're looking at a plus or minus 9.41 expected move on the SPY tomorrow. We're above that 5-day moving average, which is neutral, and we are having an RSI that is overextended. If you take a look at the Qs also has a wide open range coming into tomorrow. So the market is pricing in, like I said, a lot of volatility. Overall, we've just been in a chop box, right? So we haven't gone anywhere since, earlier to mid of November. And you can see we just been up, down, just chopping, just violent moves. So until we get into decisive break from this box is when we can potentially see more of a movement. This right here is just building open interest, and eventually if we start breaking out of these levels, we can see some sort of a squeeze. So tomorrow on the Qs, we're looking at 8.54. Keep an eye close on the dollar. The dollar, right, it's still within this wedge structure. It's still above this area of support. So if we start moving higher, that could bring the S&P 500 down. If we start cracking down through it, S&P 500 could come back up to around that 4,100 level. A couple other things to watch too is silver. Silver's been on a monster move. It's getting some attention. Silver is highly correlated to gold miners. But this is not exactly, like, in my opinion, where you'd want to start buying silver, where you have a negative divergence on the RSI. Price has expanded to the upside, and now it's contracting. You can see getting very tight here. It's going to have to take some sort of a breather or digest this move at some point. Remember, expansion leads to contraction. Contraction leads to expansion. Could be an expansion move to the upside or to the downside. Well, typically rising wedges are bearish. Negative divergences are bearish. So seeing a move down to digest what we've been seeing is definitely probable, possible. If you take a look at gold, gold is the very same situation, right? We have this kind of rising wedge structure. It was hit a little bit today, -1%. And the thing is, why I'm showing you this is if the dollar does start breaking out up a little bit further, that's going to put pressure most likely on silver, most likely on gold, continue to put pressure on gold there, just to take a little bit of a back seat. But remember, gold is starting to break out of some key levels. Yeah, we had this little negative divergence, so it's taking a little bit of a back seat, but it doesn't mean that it's not going to be a bad asset to buy the dip on. So we'll continue to monitor and develop what happens there with gold. Couple signal charts that have changed since my last video is the summation index. We finally had the parabolic SAR tick over, which could identify a change in trend. Okay, so that means that the trend could very well, very similar to how we saw it here, might be the start of a move to the downside. So you can see we came up right after we saw that trend change, and now we're starting to see a move to the downside. That is a possibility. It's a little bit too early to, I mean, it's not necessarily too early to act because there are some other signals, but just be aware that, you know, we have all this event risk coming up. Okay, so taking like just taking a one-legged approach to the market, like I'm going to go all in long or all in short, it's just not like it's just way too dangerous to do that. If you take a look at the Nasdaq summation index here too, parabolic SAR ticked over. We are below 0, so this looks pretty weak. We'll continue to monitor this after the next couple of days here. Remember, so the expected move going into tomorrow, it's gigantic, but guess what? It's even bigger going into the FOMC meeting. So the market last Friday priced in an expected move of, you know, what was it? It was this was the expected move, 406 down to 380, and just going into, you know, the remainder of this week between today and tomorrow, we're looking at an expected move of roughly around the same size. I'll be talking more about the expected move of what the options market prices in for the Fed meeting come tomorrow. But as it stands right now, this is going into tomorrow. This is the range. We're talking lots of volatility. So if you do not like that type of volatility, back off from the markets, let the markets digest, and then we approach the markets from a tactical perspective after they digest that information. Hope today's video helped out everybody. That's all I can do for you on today. See ya.